Hello and welcome to Business Television India. I am Siddharth Zarabi, and with me today, one of the foremost economists in the country, Dr. Aurodeep Nandi, India economist and Vice President at Nomura in India. Thank you very much for joining us on Business Today TV. I begin by asking you about your latest observations in a report where you say that inflation has peaked in India while growth has tanked or is tanking. I want to ask you, has inflation peaked or is it an artificial peak, Aurodeep, because petrol and diesel price hikes that should have naturally happened over the last few months have not happened because there is an artificial freeze on daily price movements?
I think it's important to understand that inflationary pressures are still pretty much live, right? So even though arithmetically it may have peaked, essentially inflation in September hit 7.4%. Part of this is because of what in economics we call lower base. So the inflation last year for the same month was lower, and hence this inflation is a bit higher. But I guess what is worrying is that if you unpack the inflation reading, you'll find that on the food inflation side, pressures are broad-based. So a number of food items have shown upward revisions. I guess what is sort of even more worrying is the fact that within core inflation, so core is when you take out food and fuel and even petrol and diesel, if you like, from the basket. Core inflation is quite sticky for India. It's been remaining elevated. Core goods inflation continues to inch up. This is despite global commodity prices falling. So essentially, what firms are doing is they're saying, all right, this will help our margins, but the price pressures are still being incident on consumers. Core services inflation is also pretty sticky. So a combination of all these factors sort of make us feel that underlying inflation is sort of more at around 6% or so level, if not a bit higher. Now, you're right about petrol, diesel prices being constant for a long period of time. So this is despite crude oil prices somewhat falling. So essentially, when crude oil prices rose quite a lot, then petrol, diesel prices didn't rise as much. And so there were under recoveries for oil marketing companies that they're trying to recoup at this point. But looking forward, inflation, we are concerned about high inflation in India. One, we are already seeing very high cereal prices, wheat prices quite elevated, stocks are low there. We could have further food inflation prices, food inflation feeding in the rest of the year. Also, we are seeing this very familiar pattern of firms passing on higher costs, both on the goods side and the services side, and that kind of sticky inflation is still pretty much there. And we are always cautious about what, again, in economics we call second round effects. So when you've had high inflation for a very long time, you're really worried that inflation expectations go up. So, your audience looks at here's your report and says, oh my God, inflation is rising, hence my expectations rise. And when that happens, that creates a kind of loop, which brings higher inflation, second round, which leads to higher wages. And that's another thing that we need to monitor. I'm not saying we're there yet, but these are pressures that we need to monitor. So overall, we are quite concerned on the inflation front. We are expecting 6.8% in this fiscal year.
Okay. And what Aurodeep Nandi has been telling us viewers is something which can be further understood from some of the data that his own report had put out. If you look at Cpi inflation, which is consumer price inflation on a percentage basis year on year, barring beverages, fuel, recreation and amusement and personal care and effects, all the other components of the entire Cpi basket have actually gone up. Fuel, as just an example to take forward from what we were discussing, in July 2022, the reading was 11.8%. In August, it was 10.8. In September, it was 10.4. So this is just one example of how the mix could change once again in terms of the risk factors if crude oil global price pressure builds up, which is not happening. Before I come to discuss a bit more of crude oil, I want to take up another point that you made about food inflation. What is the impact, the likely impact going to be as far as the hike in MSP that has been announced just as we are speaking? What kind of pass-through will it have on food inflation and perhaps further make it sticky?
So the weighted average of the MSP hike that has been announced today, so if you weight it by the respective weights in the CPI basket, the weighted average is around, if I'm not mistaken, 6.6% or so. So it is higher than previous years, definitely. For wheat, which is the major Rabi crop, it has it's sort of risen more than what it has been last couple of years. But I guess there is a certain seductive logic that higher MSP leads to higher inflation, and actually inflation is far more complicated than that. And if you look at the past growth of MSP and inflation, it's not always been similar. But I guess, see, look, the way MSP is calculated is as a function of the input cost, the agri input costs. Now, agri input costs are at multi-year highs, right? So it's getting much more expensive to produce farm produce than previous years. So it's not a surprise that MSP is high. MSP is also dependent on global and domestic factors. Now, in the case of wheat, for instance, our stocks are quite low compared to historical standards. So there's already pressure in the market. Inflation, if you look at wheat CPI inflation, that's already trending pretty high in double-digit growth rates. So a lot of the inflationary pressures, I think, are already being passed through. So the MSP shouldn't add any fresh inflationary impulse to what is there. But I think it kind of is in my perspective, I think it's reasonable given the current demand-supply situation that we have in the country.
If elements of inflation are sticky and inflationary expectations have built up and may continue to further build up, we are seeing a pretty robust pre-Diwali sort of purchasing environment, consumption environment. Anecdotally, we will see the data come out. But how do you see inflation performing post-Diwali right up into the central government's budget and by March, because this is also a period of certain weather-related disturbances, for example, in the vegetables component. And we don't know how crude oil will perform, whether there will be a further worsening of the Ukraine conflict. So give us your forecast for what the average customer or consumer as well as the producer should expect in the next 3 to 4 months.
Right. So, the question that you've asked, I can give you a figure, but truth be told, inflation outlook at this point is beset with a huge amount of uncertainty. And you've mentioned it yourself. It's very difficult to predict what's going to happen in the Russia-Ukraine crisis. It's very difficult to predict what kind of, what the impact of unseasonal rains is going to be. As you rightly mentioned, in the last few months of the year, typically vegetable prices have spiked up in the past few years. Now, whether that translates into higher vegetable CPI is something that remains to be seen. One has to be aware or sort of be cautious of those impulses that could come. Also, generally, if you look at just wheat stocks, rice stocks, then you do see that there are pressures that are building in on the food inflation side. Now, on the core side, I think one is really perplexed, one could say, in terms of how sticky it is. And I think that's something that the RBI also has to contend with. Part of this is demand driven. And so the whole idea of the RBI raising interest rates at the end of the day is having some degree of growth sacrifice that will eventually and hopefully bring down a part of this sticky core inflation. So overall, despite you're taking into account all the uncertainties, we think that inflation is going to remain above 6% for the last quarter of the fiscal year. I think we are slightly above the RBI's projection of 5.8%. The Q1 of FY24, I think we are in line with what the RBI is saying at around 5%. But, again, a big caveat is that 5% comes on a much elevated base. So, once you take that base away, then again, inflation could rise in the coming quarters of FY24. So really uncertain times. There's also going to be the impact of the global recession that is likely to happen. It seems increasingly certain next year.
Right.
What impact that will have on global commodity prices is also going to be a very interesting determinant.
Those are very important points. This is not a unique situation. Every economy, there are cycles, and we are again in a cycle where you could go back into historical data, but we won't do that because much of it may not be something that people understand. It's also a fact, Aurodeep, that anecdotally, if anyone was getting his house done up after the COVID hiatus, or if you've gone out to purchase certain household goods, even if they are not exactly essential necessities, you would have realized that the price component increase is immense and can't perhaps actually be captured fully in data. Let's move on from the price situation and take up another aspect, which is that industrial production, which is what we produce, and a lot of that gets exported, is down. And again, there is some good data that's been crunched by you. Give our viewers a sense of what's happening as far as industrial output is concerned. The headline obviously being that it weakened further in August.
Yeah, so industrial production has been quite surprising. It's been quite weak, and I think this is one of the reasons why we are starting to get nervous on growth, because industrial production essentially was minus 0.8% on a year-on-year basis. So that's compared to what it was last year in August. Versus 2.2% in July. Now, there is a concept known as sequential momentum in economics, but without getting much into the technicalities, essentially the industrial production over 2 quarters over the past 2 months, has weakened quite a lot, right? So to give you an example of how much it's weakened, we and market was expecting 1.6 or 1.7% for this number, 1.7%. And what came out was minus 0.8%. And if you compare it to, so if you take out seasonality and base, in fact, industrial production currently is below pre-pandemic level. So these were levels that we last saw in Jan or Feb this year. So, we've been seeing a lot of weakness within industrial production, in particular within the consumer goods side, both consumer non-durables as well as consumer durables, and it's also broad-based. And I guess, so if you look at the industrial production side and you look at what's happening on exports, which has started weakening quite a lot month on month, our monthly trade deficits are pretty elevated because of that, because our imports are pretty sticky, whereas exports have started falling quite a lot. And then that makes you think, well, what's really causing this, right?
Yes.
So the first case of nervousness is the fact that the global climate is already started slowing down. Now, we believe that the US is already in a recession in this current quarter. And the whole of next year, it's going to be pretty much in recession. as is the case that's going to be for, say, Europe, as it's the case is going to be for a number of developed markets. So you're going to typically see a hit to exports. I guess what is worrying is that before we've actually hit the recessionary iceberg, exports have already started slowing down. And then there's also the other thing, which is that a lot of the momentum happened post-pandemic, which is that pandemic got over and then people started recovering and growth started picking up. Now, one of the things that we are seeing, not just in industrial production, but in the broader set of indicators that in August and September, is that it kind of peaked in Q2 of the calendar year. So that's April to June. Most growth indicators peaked. And then August and September, we are slowly seeing across consumption, across investment, across external sector, there is a kind of slowing of momentum.
Right.
And particularly in the case of services, services was around 20 percentage points above pre-pandemic level by our estimate in Q2. That's now around 8 percentage points. So what could be happening is that you could have a kind of reopening boom that is now ebbing away. So now you've already opened up. So that boom is no longer there. And it's slowing off in a point where the global environment is also quite weak. If you draw a chart of global GDP and India's GDP, I don't think there's ever been a situation where the global growth situation has been bad and India has done well. So India is not decoupled from the global cycle. So I guess those are the factors that are starting to play on the growth side.
In fact, that was what my next question was, which I'll ask you so that our viewers can understand this. Is this a pre-Titanic kind of moment for the global economy? And will the Indian ship, which is not as large as the Titanic was, and thank God for that in the current circumstances, will we somehow avoid that iceberg and maybe just get away with a few scrapes on the side?
Okay, so let's put it this way. If this was India's ship in, say, 2013, or if this was India's ship in the 90s, then we could have definitely made a movie out of it, right? Because it would have been it would have been a tough situation. So look, I mean, I don't think that India will be unscathed, right? It's impossible in such a situation. And also, let's be frank about this. At this point, we don't know if it's going to be a soft landing or a hard landing for the global economy, right? So we are getting into uncharted territories, literally, when it comes to the recession happening globally. And I think it's also very important to understand why this recession is happening. This recession is happening because inflation globally is refusing to come down. So it's literally like a controlled explosion that central banks, especially in developed markets, are trying to do. They're trying to raise interest rates very high in order to bring down growth and in order to bring down inflation eventually, right? So at this point, how growth will react to this kind of very high interest rates remains to be seen. As far as India is concerned, look, the macro fundamentals are better this time around. So, we didn't do too much of fiscal stimulus or monetary stimulus during the pandemic. So we have some degree of comfort there. The fundamentals are better. The balance sheets are better for corporates. So compared to previous times, I guess India we've got better forex reserves, so more fortified. But there is going to be a hit to exports, to investments. And I guess what is worrying is the fact that even without a global crisis, even without the iceberg ahead, private investment has been lacking in India, right? So despite corporates improving their balance sheets, they've not really done much capex. And the concern is that, look, that is going to get further impacted when the global conditions become weak. On the consumption side, our consumption remains very what is known as K-shaped. So if you are a person who's somewhat rich, who is belonging to the formal sector, you're doing much better than the person who's informally employed or is much poorer than you. As a result of which, you're in a situation where the consumption engine itself is in a very skewed setup.
Right.
So now, if you look back and you wonder what's going to drive India's growth, is
Right.
it going to be consumption? Well, somewhat, but you need to be cautious there. Is it investment? Probably not. Is it exports? Probably not. So then it's essentially consumption and government, right? And so, which is what makes the next year a really interesting year for growth. We are quite bearish on next year. We expect FY24 to be 5.2% versus 7% in FY23. So we are actually below consensus in terms of our growth outlook for next year.
Okay, one final quick point. Global central banks are doing what they can after what they did during COVID times, which is flood the markets with money, and that's why we see unprecedented inflation all across the world, especially in the most developed countries. What do you expect the Indian central bank to do in the situation with persistent inflation and slower growth?
So the MPC has already, the Monetary Policy Committee that sort of decides what the interest rates are going to be every 2 months, have already started showing cracks within themselves. So the minutes that came out last week of the September meeting shows that the erstwhile hawk Jayant Verma, Professor Jayant Verma, has become essentially one of the outlier doves now. So sort of saying that, look, 6% is enough, 1% real policy rate is fine for us. We need to wait and watch. We need to see what will happen to growth and then decide. Professor Ashima Goel has also been of the same view. So out of the 6 members of the MPC, 2 seem to be of the view that, look, we've hiked enough, and 6% is broadly the level where it should be. Now, the RBI has been tight-lipped about giving forward guidance, but Governor Das has mentioned that, look, despite all the hikes we've done so far, monetary policy conditions still remain accommodative. Deputy Governor Patra has said that, look, monetary policy needs to be on red alert. So I think we are reaching the end of the tightening cycle. I don't think India and even other emerging markets, especially in Asia, are going to tighten to the extent that other developed markets are doing, simply because our inflation levels and impulses are lower and much different than what the developed markets are doing. But we don't think that they're going to stop just yet. So we are expecting 6.5% as the terminal repo rate. So we expect a 35 basis point hike in December, 25 basis point in Feb. Now, it could be that, December could be the final rate hike, but that depends a lot on where October inflation is going to be, which is the last inflation print the MPC will get to see before they decide on the December interest rates. But just one point that I think is worth mentioning is that India's target inflation is 4%, right? We are now at 7.4%. Underlying inflation is around a little over 6%, right? So we are not even close to the upper band of RBI's tolerance level, right? So it will take some time for inflation, take some time and take some luck for inflation to kind of settle down at 6% and then go below. And really the concern is that at one point there is a growth sacrifice that is involved in trying to bring inflation down, right? And the key question is whether in a global recession year, policymakers would be ready to make that kind of growth sacrifice in order to bring inflation actually down to 4%.
Right.
So we might end up being in a situation where policy rates sort of remain somewhat elevated at 6.5%,
Right.
but then medium-term inflation also remains a little high.
Absolutely, and take into account, viewers, what Oradeep was telling us, 4%, and if you were to pass on petrol and diesel, that 7.4 could actually have been 8%, so double of that 4%. But that's not the case, and we must always remember the other point that he said, In India, there's a certain mass of people which are protected from some kind of inflation through government support. There's a chunk in between the middle class, the tax-paying class, which perhaps gets exposed the most, and for the rich it doesn't matter. So that's how the politics of the situation will pan out. Aurodeep Nandi, thank you very much for your time with us today. We'll keep a close track on growth and the price surge with you sometime again. Till then, goodbye, and thank you very much for your time.
If you like the video, do like, comment, share and subscribe.